How's it going, everybody? How's it going? I definitely appreciate you guys taking the time out to watch this video. If this is your first video of mine watching, my name is Jameer Walton. I'm a licensed real estate agent here in the state of Illinois. And right here next to me is the number one mortgage lender in the Chicagoland area, Mr. Corey Singleton and his team. Just to give you guys a brief introduction, I've definitely been working with Corey for a couple years now. And me personally, he's also the lender that my wife and I just used a few weeks ago, actually, when we just purchased our 2-unit property. I'll definitely let Corey just give a little introduction about himself, but if you're a client of mine, you're gonna hear me talk about this a lot. Just have a conversation with Corey because Corey and his team has been in the industry now for over 15 years. And in 2018, actually his team did $24 million in revenue. So this is someone that's not only a heavy hitter, but he's pretty much seen the good, the bad, and the ugly with the mortgage industry. And that's really somebody you really want to have in your corner because you don't want to have somebody that can just tell you all the things that can go right. But you also want to have somebody who has the knowledge and experience that can tell you, hey, if you do this, this is how this can also affect you in a bad way. So again, Corey, I definitely appreciate you taking the time to really have this video with me. And I just want to just get right into it with a few topics. The very first topic I definitely want to talk about is debt to income. So that's definitely a topic that even myself personally, before I became an agent, before I started my own pre-approval process, I wasn't familiar with it. So I just really want to have the time for individuals to be able to learn ahead of time what is debt to income and really how it affects them when they're looking to purchase a home.
Okay, good. That's an excellent question. A lot of people don't understand. The short term is DTI. So when you hear a lender or a professional talk about DTI, that stands for debt to income ratio. And what that means is we take your monthly gross. Everything is based upon monthly because that's how often you're paying your mortgage. So we take your monthly gross income. So let's just say, for instance, you make $60,000 a year. Divide that by 12. That's $5,000 a month as your monthly gross. So now we're working off of that number. So when we talk about debt to income or DTI guidelines, different guidelines have different debt to income ratio restrictions or maximums. So the most flexible would be FHA. Depending on your profile, if it's a strong profile, you can go up to about 55% DTI. But ideally, you want to stay under 45%. So you take your $5,000 monthly gross income and you multiply. Can I grab my calculator here?
Okay.
And you multiply that by 45%. And that's going to be our starting point. So that gives us $2,250. So that's that's our starting point. We go from there. So at that point, what I'm going to do is subtract what you're already obligated to on a monthly basis. You got an auto loan?
Yep.
Right? So we just subtract that payment. What is that? Just not yours. Just give me one. Give me a number.
400.
$400. All right. Then you got, let's just say, a couple of credit cards, right? You don't have them maxed out. You stand under 30%. So your minimum payment on it is $25 each.
Yeah.
So subtract another $50, right? Oh, I just messed it up. $2,250 minus 400 minus 50. Right, and you got student loans, which we'll talk about that maybe on another video.
Yes, sir.
All right, but let's just say the payment on it is $150.
Okay.
All right, so we'll subtract that $150. These are the things that you're obligated to. I'm gonna get this calculator right at some point. Minus 50 minus 150. This puts you now at this point. I'm gonna say, hey, your max payment is $1,650.
Okay.
So that's how we calculate. So we started at your monthly gross. We went to 45% of that. Okay. That's ideal. And then you start subtracting what you're already obligated to. So $2,250 is 45% of the $5,000. Okay. You subtract your auto loan payment, your credit card minimum payment, and your student loan payments. Okay. And what's left can be allocated towards your mortgage payment. So I can qualify you for $1,650 a month as a mortgage payment.
So that's almost like the bank saying that's what we see comfortable, that you can afford.
Exactly.
Exactly. Okay.
Yep. And that's DTI. That's debt to income.
Yeah, no, guys, like you really, really want to make sure you're taking notes on that because even myself, I use that personally. So just to give a little personal story, Whereas I think I first got pre-approved from Corey's team, maybe I want to say March of last year.
Okay.
And pretty much, I knew we were probably like still 8 to 12 months from where we were actually going to be ready to buy. But the number one thing is you need to know where you currently stand.
Right.
So Corey and his team were immediately able to let me know, hey, this is what you're pre-approved for right now. And this is the property tax you're pre-approved for. As I started to talk with him a little bit more and learn about DTI, debt to income, one of the strategies that helped me with my pre-approved to where my wife and I, we were able to get pre-approved for more, was that at the time I had a lease with my car.
Right.
And my lease was like $460, I'm like $455, $460 a month, including the warranty and everything else. But I already had made a decision I wanted to keep that car. I wasn't trying to trade in or get another car.
Okay.
So once I made that decision, I then changed it from a lease into buying it. Well, now because I changed it from a lease to buying, now my monthly car note went from $455, $460 to now it's currently $360, $365. It doesn't sound like a lot, but as far as your DTI, your debt to income, that's now an extra $100 that's not showing on there. So and it was the same car. I just changed the financer from a lease to buying. Now I'm not saying to do that if you're not trying to keep that car. That was just for my situation because that was the car I wanted to keep. But again, it's little small decisions like that can add an extra $20,000, $30,000, $40,000, $50,000 to your pre-approval.
Yep.
Little tiny decisions. So when I tell you guys you want to have a conversation with Corey and start the pre-approval process, it's much bigger than just, I don't want my credit ran right now. It's like, no, you need to learn how you can, it's almost like a chessboard. You want to learn how you can structure your pieces so now you can put the home in checkmate to where now you're in the perfect position to be able to get like that in the perfect position because again, it's not about just getting it right now. Getting a pre-approved doesn't mean that, okay, I'm getting my credit ran and that means I have to buy a home right now. No, it's just telling you where you are currently, but also now you have an experienced individual in the field who knows exactly what the banks are looking for and that can tell you, hey, if you say you want a home in this area and your agent is saying, hey, the homes in this area are $200,000 and you're only pre-approved for $150,000, now that's a conversation you can have with Corey and his team to say, what can I do on my credit? What can I do on my financing to get from $150,000 to $200,000? You might even find out, and we'll talk about this in another video, it might be one little small adjustment in your student loans, one little small adjustment in your pay stubs that can be the extra $40,000, $50,000 difference. But you won't know if you're still trying to be on the sideline and not trying to get in the game. In order for you to be able to say that you're a player in the game, you have to eventually put on your shorts, you got to put your jersey on, and you got to get in the game.
I want to play.
You have to get in the game. And trust me when I tell you, you want to have Corey Singleton and his team on your team because it's not just Corey, it's an entire team of individuals that they have that's really going to help you get from getting a property under contract to the closing table as quick as possible. So this is just video series number 1 on debt to income. Definitely make sure you tune in to the other videos that we have because you need to know this information so you are not only prepared, but you're confident when that time is ready for you to purchase that home. So again, I really appreciate you guys taking the time out to watch this video. If you got any other questions or you want, feel free to reach out to Corey or myself. I'll definitely have Corey's information at the bottom of this video, and I'll also have my contact information at the bottom of this video. So definitely make sure you guys take a lot of good notes and tune in to the next video.
Thanks for watching.